Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Now in this video, we're just going to be diving deep into one of the most powerful tools in Forex trading, and these are oscillating indicators. All right. Now these indicators can help you spot reversals, identify overbought and oversold conditions, and measure market momentum with precision. So if you have ever wondered when to enter or exit a trade, then you need to master these tools. All right. So stay tuned, because by the end of this video, you'll know exactly how to use the RSI, MACD, and Stochastic Oscillator to improve your trading strategy. And hey, if you're serious about taking your trading to the next level, don't forget to smash that like button and subscribe to the channel so you never miss an update. All right, let's just jump right in. Now, oscillators are a type of technical indicator that fluctuates between fixed levels. Now, these levels are usually between 0 to 100. Now, I'm just going to be adding a couple of indicators to the chart. Popular oscillating indicators. Okay, one of them is the RSI, right? The relative strength index. Another one is the MACD, the moving average convergence divergence, and finally the stochastic oscillator. Now, these are three popular and effective oscillating indicators that a lot of traders use. All right. Now, when price reaches extreme levels, it often signals a potential reversal. These indicators help traders determine whether an asset is overbought or oversold while measuring strength and momentum of price movements. Okay, so that is the reason why these indicators are essential for traders who want to time their entries and exits with precision. Now let's just break down these indicators one by one. All right, first up, the RSI, the relative strength index. It is a momentum oscillator that measures the speed and change of price movements. It moves between 0 and 100, with the key levels being above 70 for overbought, meaning the assets may be overvalued and due for a pullback, and below 30 for oversold, meaning the assets may be undervalued and due for a bounce. All right, so how do you use this indicator? If the RSI is above 70, it's a warning sign that price might reverse or slow down, right? But if the RSI is below 30, it could be a good time to look for buying opportunities. However, RSI is not a standalone tool, right? You should always combine it with other signals for confirmation. Next, we have the MACD, the moving average convergence divergence, which is a dynamic indicator that helps traders to spot trend shifts and momentum changes. Now, the MACD consists of three main components: the MACD line, which shows short-term momentum, the signal line, a moving average of the MACD line, and finally the histogram. Right, which shows the difference between the MACD and the signal line. So now, how do you use the MACD? Okay, when it crosses above the signal line, it's a bullish signal, right? But when the MACD line crosses below the signal line, it is a bearish signal. So an upward crossover is a bullish signal, a downward crossover is a bearish signal. And then many traders also look at the histogram. If it starts to grow, if the histogram bars start to lengthen, it shows that momentum is increasing in that direction, right? However, if the histogram bars start getting short, it shows that momentum is getting weak. All right, MACD is especially useful for confirming trends and spotting early trend reversals. Now let's talk about the stochastic oscillator. Last but not the least, right, we have the stochastic oscillator, which is perfect for identifying overbought and oversold conditions with even more precision. Now, the stochastic oscillator also moves between 0 and 100, but it focuses on the closing price relative to the price range over a set period. So the key levels are above 80, which is an overbought condition and price may reverse downwards, while below 20 signifies an oversold condition and price may bounce upward. So how do you use it? One of the best signals comes from stochastic crossovers, right? Which is when the percentage K line crosses the percentage D line from below 20. Now the percentage K, let's just look at that. You can see the percentage K is the main line, which is, you can actually modify the colors, all right, according to your taste. You can actually modify the colors, right? You can modify it according to your taste. So the main line is the percentage K line, right? While the signal line is the percentage D, all right? So when the main line or the percentage K line crosses above the signal line or the percentage D line, you have a buy signal. Then when when the percentage K line crosses below the percentage D line, then you have an oversold. Or how do I put it now? Apart from that, it is better to have a bearish crossover around an overbought territory and a bullish crossover around oversold territory. It adds validity to the signal, okay? But before you go, let us talk about some common mistakes traders make with oscillating indicators, all right? The first mistake is ignoring the overall trend. Now, just because an indicator shows overbought does not mean the price will drop immediately, all right? Strong trends can keep pushing price higher. So it's important to take note of that, right? For example, let's just use this as a very, very practical example. We can see that we had a buy trend here. It was quite a strong buy because you will notice that the RSI entered overbought. Okay, let's look at this. Yeah, you can see that the RSI actually hits the overbought territory around here. The buy, look closely, right? Look closely. Can you see that this buy trend has started since? You can see that it had already started for a long time, right? And you can see that here, the RSI entered overbought territory, stochastic entered overbought territory, but that didn't mean that the trend had come to an end, right? And you can see after a series of pullbacks, you can see that the RSI entered overbought and the the stochastic entered overbought again. Doesn't mean that the trend had come to an end, and yet again you can see that it entered overbought territory. So if you just decide to sell, immediately you find the indicators in the overbought territory, then you will notice that your sell trade will get stopped out, or you will be in a large loss because the price kept on going up. So do not make the mistake of assuming that because the indicator is in overbought territory that it is time to sell, or because the indicator is in oversold territory that it is time to buy, all right? Then the second mistake is using one indicator alone. Always combine your oscillators with other technical analysis tools like support and resistance levels or price action signals, all right? So take note of areas of rejections on your chart, support levels, resistance levels. Take note of that because they also give you they give you a potential reversal points, right? Potential points of rejections for the near future, okay? And then do not make the mistake of overcomplicating your setups, all right? Keep it simple. Focus on one or two oscillators that fit your strategy. Now, you don't necessarily need to use these three oscillators at once, okay? You can actually select one or two according to your strategy, all right? The best practice is always wait for confirmation signals before entering a trade. So that is it, traders. That is a wrap. Now you know how to use RSI, MACD, and the stochastic oscillator to analyze the markets like a pro. Which indicator do you use the most? Drop a comment below and let me know. If you enjoyed this breakdown, hit that like button, subscribe if you haven't already, and turn on notifications so you never miss a trading tip. I'll see you in the next video. Happy trading.